What's going on, guys? Welcome back to the Gen Z Money Podcast, where we turn financial peace to your reality. I'm your host, James Bowman. And today, guys, this is a bonus episode. I know I normally upload on Sundays, and I did upload an episode on Sunday where I interviewed the neighborhood finance guy, Lawrence. And I wanted to put out this video or this episode because I know that the market is kind of going crazy, right? As we know, the S&P 500 is down 12% so far this year. So we could be ending up going into a recession, bear market. Mortgage interest rates are going crazy. We don't know what they're going to be doing with student loans. And so I normally record episodes, 30 to 60 days in advance. And so we don't really talk about what's going on absolutely today. So today, that's what I wanted to do. I wanted to bring on the expert, the guy, the man with the plan, Joey Snyder, our residential financial advisor. And me and him go over everything that is going on in the market today as of May 30th, which was recorded yesterday, and I'm putting it out today on May 31st. So I really hope that you guys enjoy. I really hope you guys get some enlightenment from this, because this is going to let you know everything that's going on, why it's going on, and hopefully how you can get around it. I mean, everybody's afraid, right? So this episode is to kind of knock that fear out of you and get you confident investing for the long term, like we teach. So I'm not going to get too far down it. Just absorb the information. I'm going to have a bunch of links and articles and things like that in the show notes. So make sure you guys check that out. But let's just get into my conversation with Joey about the current state of the market. Hey, Joey, welcome back to the Gen Z Money Podcast, man. I appreciate you joining me today on this bonus episode to just talk about the blood in the streets, as they call it in your industry, right? The world is falling apart. It's some people, okay, the news is saying the world is falling apart. We're going into a deep, dark depression and everything is going to hell. We need to buy all gold, buy all Bitcoin, and weather the storm, man. So I'm glad that you joining me to talk about what's going on in the market today and how people should be responding to it and how you're advising your clients to respond to it.
Absolutely. I'm excited to be back. I think this is definitely one of those times where we talked about in previous podcasts. I know you've talked to other people where people start to do things that they might not do otherwise. So a lot of smart people can definitely make bad decisions during a time like this.
Yeah, I think when people are fearful is when they don't put much thought. If they go into a fight or flight response. And so that's what we're seeing right now. Some people are like, okay, shrugging their shoulders, and other people are like, okay, I need to get out and wait for the bottom, and I need to come up. And so a couple things we're going to be going over this episode, guys. Like I said, this is a bonus episode, and this is just to talk about the current market as today, because there's a lot of things going on. So we're going to be discussing the current market conditions. We know that there's been a pretty drastic drop this year. We're also going to be talking about mortgage rates going up. We're going to be discussing student loans and all the talks around those. And then we're going to discuss a little bit of I-bonds to kind of finish out the episode, just to kind of get a well-versed area. So Joey, let's start right here, right? What, with the market being down currently, I checked it yesterday, 12.22% year to date. That's the S&P 500. That's how much it's down from January. Can you go ahead and just give a quick definition of, like, are we going into a recession? Are we going into a bear market? Or what is this really?
Actually, a great question, because a lot of people ask me this during meetings, and I always refer to this great article that one of our investment team had sent us. And essentially, when you're looking at the markets, a S&P 500 loss of 10% or more is viewed as what's called a correction, where over a 20% loss is a bear market, or a quote recession. So right now we're still in that market correction phase. We have not hit the quote recession period yet, but that doesn't necessarily mean we're out of it. And looking back at just the data, a lot of things I like to point out are just also, people ask, well, when should I get back in? Right. Well, first, you should have never gotten out of the market. So when you look back at the data, I like to refer back to the most recent big market run we had in 2020 during, or market recession we had during COVID, whenever it first came out. When you look at that period, that was essentially February 19th of 2020 to March 23rd, 2020. During that 33-day period, the market lost 33.9%, or the S&P 500 went down by 33.9%. So that was the last time we had a bear market or a decline of 20% or more. It literally only took 33 days for the market to come back. People looked at that and were like, believe it or not, that was actually an anomaly. That was something that does not happen often. So when you look back at the data and we're starting to go towards that trend line, I think we really should change our mindset that we might be in for the long run. So it's not a matter of trying to time the market. I really tell clients to be prepared for this being a long-term possible market downturn, not something that's going to hit a 33% decrease and instantly come back in less than a month. And then we're all singing roses again, where we're seeing insane market returns, right? Obviously, the Fed's already increased the rate on lending. So there's a lot of things that are trending towards what a lot of economists view as a possible market downturn. But going back to the data I was mentioning, the last time in history, let's even be a nice here, and the last time in history where the market went down by more than 20% and lost more than 20%, and it took less than 100 days for the market to recover. The last time that happened was literally 1957, and that was 99 days. So when you look at that in history, it's been over 70 years since it took less than 100 days for the market to recover after 20% decrease. So that's something that I've really been eyeing with a lot of clients, that if we start to get to that point, then we really should prepare for this to be a long-term thing, not a quick 20-30 day recovery. Everything's fine, right? So that's something I've been tracking quite a bit. So a lot of clients have asked, when should I get in or when should I get out, or trying to time the market per se. Obviously, everything now is at a quote discount rate. That's something where I tell clients, as we continue to dollar cost average, continue to invest monthly, we're simply just buying at a discount. It's still not that big of a discount, right? Only 12%, like you mentioned earlier, James. So we are on a downturn, but I think possibly we may continue to go there, but who knows, right? We're predicting at this point, but data shows that if we do get to that 20% decrease or more, we're most likely looking at well over 100 days or more for the market to recover. So definitely something that we should look at as a long-term plan. And that's something that we've preached for however many episodes at this point, right? Is everything you're doing when it comes to finance and wealth management should be viewed with a long-term perspective. Yes, there's obviously short-term goals you're going to have, but you should always take a long-term approach. Even when we talked about crypto and things like that, those are all things that should be viewed as a long-term investment solution versus trying to get rich quick. So just a couple things to think about when we're looking at what we're looking at currently, but also what we can start to project out.
Yeah, Joey, it's funny because you keep throwing out this 100-day thing. And when you say 100 days, some people who are short-sighted may think, holy cow, 100 days, that's a long time for my recovery. But when you have people that are looking at 20, 30, 40, 50-year investment horizons, 100 days is, I mean, it's like 0.003%. Like it's such a small, minute time. So even
Correct.
when you get up to the point where we're talking 6 months or to a year of recovery, again, if you look at that in the short term, that might be a long time. But when you're investing for the long term, you're investing to retire with dignity and respect over 20, 30, 40 years. That 1 year is what's the mathematical term? Insignificant.
Exactly. And even going on the far end, in the dot-com boom of 2000 to 2002, it took 900 days for a recovery from a 49% decrease in the market. So that's kind of if you looked at it on the long-term perspective, even that's not even a full 3 years, which same thing, right? 3 years in a 40 to 50 plus period literally is very, very insignificant.
Yeah, man. And I love that you started off with the COVID recession correction drop phenomenon, because that's the one most of us have lived through. And I lived
Yes.
through that one. And I remember the fear that I was feeling watching my retirement account drop every single day. I mean, the
Yep.
surge protector on the stock market's going off. I'm like, I got to pull out, I got to rebalance, I got to do all these things. And luckily, I didn't, because otherwise, like you said, I would have missed that. What'd you say, 30-day recovery time where it basically got back to where it was. So I've only lived through one, and I remember my emotions. And so living through this one, I remember how my anxiety had no real basis, And so now I don't even check my portfolio. Like I might check it once a month just to say, dang, oh well. But the only time I really checked it in the past month or so was to get the statistic for today to see what the market has dropped.
Yeah.
So
Yeah.
for others who have lived through that COVID recession and they were investing during that time, you kind of have to look back and look at the emotions you felt during that time, and then look at the mistakes you might have made to not sell off and miss such a bull recovery, as I think that we would call it.
Exactly.
So with that being said, I kind of want to go over something, because you talked about the discount currently on stocks, and what our brains are meant to think linear, right? 2 + 2 =
Yes.
4, 4 × 4 = 16. Our brains are not meant to think exponentially. And so when we're talking about gains and losses in the stock market, we sometimes, at least when I started out, and I still kind of do sometimes, I think in order to recover from a 10% loss, I need a 10% gain, and that'll put me back to where I was. But that's
Right.
not necessarily the case, right?
Yep. Well,
So
actually, the one way to look at that too, like I know a lot of times, like for example, sports betting is very a big thing now because it's become legal in a lot of states. When you look at sports betting, they always call it the juice, right? Whenever you go and you bet on a line, if so, for example, the NBA Finals game last night was -3 line. If you go and bet -3, you're going to get a -110 payout, which means if I put 100 bucks in, I technically get $90 back as winnings. So you're paying basically $10 of juice to win those $90, right? So when you look at that, you're thinking, well, same concept. If I lose 10%, I need to gain 10% back. But you're not thinking about the compounding interest effect. And the reality is, well, if you went and just bet on the quote dog straight up to win, the line is like +200. So typically on the rebound, that negative 10% decrease is actually probably closer to like a negative 15 or a 15 or 20% return when you look about the way it's computed on the back end, right? So you're exactly right. It doesn't just work -10 to +10. That's not how it works at all. Usually when you're buying at the discount, you're going to actually get a higher overall return as you get back to that, I guess, point where your loss, I guess, right? So I wish I had a better example off the top of my head in terms of the calculation, but you're exactly right. It's not a apples to apple -10 to 10. Actually buying at that -10, you're going to get a higher rate of return on the back end, especially because now you bought at -10%, but you also bought significantly more shares, right? So now you go and we'll actually keep the number simple. So you buy, say it's $50 a share, you buy 2 shares, right? Then loses 10%. So that means now your shares of $50 go down to $45, if my math is correct.
mhm,
And you put your same money in there. Now you buy, instead of 2 shares, you bought what? Double. So
2.1 or
we have
something.
2.1 or something like that, right?
Mhm.
In that particular case, then when it comes back to $50 a share, now instead of just being straight up even, you actually have 4.1. So you technically have an extra additional, quarter share that now is worth the same price, right? So it's building on top of itself versus just going back from 50 to 45 back to 50. It doesn't work in a linear pattern like you said. So when you factor in that you can get more shares, the example I always use is, of course, is funny during COVID is toilet paper, right? We had the big toilet paper pandemic. If you went to Costco and $20 buys you 20 rolls of toilet paper. Well, if you went to Costco the next month and all of a sudden 20 rolls costed $5, you most likely would have used the same $20 and now bought 4 packages. So now you've got 100, 20, 40, 60, 80 rolls, right? For the same $20. Well, guess what? If you hang on to those 80 rolls and now it gets back to $20 a package, you know what people are also doing and eventually got caught doing it? Going back and buying a bunch of it and then selling it back to people, right? Because now the price on that has increased. Now you get money on all those 80 rolls you bought for basically a 50% discount, right? So when you look at that perspective, typically when you see a huge discount like that, people not only are they wanting to buy it, but you're probably going to buy, in that case, 4 packs instead of just 1. Right. So same concept with it being at a discount, you're not just looking at the price, you're also looking at the amount of shares you could buy in addition to with the same purchasing power. So it's inflation working in the negative way, right? Now your purchasing power is higher versus when it increases is when everybody wants to, of course, invest, and now your purchasing power is less.
Exactly. And it's like the way to relate that back to the stock market, the toilet paper example is when the market is down, you're not going to change your dollar cost average at all. You're not going to say, well, since stocks are 10% less, I'm going to invest 10% less. Like, no. That's not what you're supposed to be doing. You're supposed to be consistently investing the same amount, whether it's $500 into a Roth or 20% of your income, like Joey teaches. You're going to continuously be doing that. So whether it is 10% up and you're buying less or 10% down, you're buying more, and the upside is much higher. With that being said, I have a quick little graphic just to explain to you guys how this arithmetic works. So for a 10% loss, you need 11% to recover. For a 15% loss, you need an 18% recover. For a 20% loss, you need a 25% to recover. 30% loss to a 43, and it goes all the way down, increasing until you get to a 90% loss. In order to get back to where you were now, you would need a 900% recovery. I say all of this to say that people are always focusing on, Joey, when is my portfolio going to get back to where it was? Instead of the growth. If you continuously invest, if you continually dollar cost average, you should be focusing on the growth that you're getting from the newly purchased stocks. Because if you're, let's just say you're a really, really bad stock picker and your portfolio drops 90% and you decide, you know what, I'm going to stay the course. If it ever gets that 900% increase, the original stocks you got are going to go to the same price, but it's all the new stuff you bought that gets that 900% increase. That's what you need to be focusing on, because that is the compound effect. So yeah, it's like, it's the losses and the gains aren't even, and it's very, very hard for us to wrap our head around it, as humans, because we're just not meant to think like that.
Exactly right.
So I want to talk about, you went over the .com bubble, how that dropped and how long that took to recover. I want to kind of go over our worst ever stock market crash and our average stock market crashes, because a lot of people want to know, like, okay, how bad can it get? So
Absolutely.
you want to talk a little bit about that, or you want me to take that?
I'll give you the same number of days. So in terms of, you're looking at, so this same article says, so the worst period, which was April 10th, 1930 to June 1st, 1932. During that period, it was a 83% decrease, and it took 783 days for recovery. So if you really wanted to know the absolute worst case scenario, worst point in history, there you go. Which still isn't that bad.
But we're talking a 83% loss over a couple, like less than a year, but it took a little over 2 years to recover to its pre-crash state.
Correct. Yep. Actually, two years and 1.5 months exactly for that 83 loss, and then 783 days. So 36, almost same thing. Literally less than 3 years. So 2.5 years to recover.
Yeah, I think that puts a lot of things in perspective, and that is the worst. And if I'm not mistaken, you can correct me if I'm wrong, this was the Dow Jones they were tracking. And
Yes.
I like to compare apples to oranges. The S&P 500, which, that's what I invest in mainly, it's 500 companies. The Dow Jones is 30 companies. So when it comes to diversification, the odds of 500 companies dropping 80+% compared to 30 companies, it is less likely. Does that mean that it'll never happen? We can't predict what the world's going to end up doing. There could be nuclear fallout. We don't know. But the odds of it happening to 500 companies is much less than 30 companies when it comes to the Dow Jones.
I mean, the Dow and the S&P are, of course, somewhat not necessarily similar. You're exactly right. They're tracking, significantly less, but that even goes back to what we talked about too, of like that kind of just shows the importance of just also actually proper asset allocation. Because, like, for example, even when we are looking at that number, if you just had a properly asset allocated model, this is also tracking all essentially domestic equities, right? So you're only tracking the large US equity companies or the largest US companies. Whereas if you had a properly asset allocated model where you have small cap, large cap, you've got international holdings, some people might have real estate investment holdings and so forth. You're also limiting that exposure to one of the biggest areas, which is really US equities, right? And so typically, same concept, regardless of what each asset class is doing, if we're consistently investing in a properly asset allocated model, you're going to be able to dollar cost average in all of those asset classes and hopefully limit the downside. Yes, you might possibly be limited on the upside, not always, not limited as much, but you're going to help kind of be somewhere in the middle there versus really kind of riding the full up and down swing of the market. And that's one thing I think a lot of investors have really been kind of smacked in the face with, the realization that, yeah, it was kind of nice with all that, Tesla and Amazon and Apple stock, whatever it was. It was kind of nice riding that wave. And those are the ones that have been hit the hardest. Some of the largest US equity funds. So, or holdings, I should say. So you're kind of going to get the high and low on both ends of the spectrum there when you're only investing in, the quote largest 50, like you mentioned, the largest 500, where that's also in the grand scheme of things, such a small portion of the overall market, right? So it's always kind of looking into the perspective of understanding what's being recorded, but also, or what's being reported, but also realizing that we have to always stay diversified and consistently invest in a consistent strategy. If we start bouncing around, so you can go from Dow to S&P, right? You're going to be in a scenario where you're almost kind of trying to chase a return that you're never going to obtain by also continuing to reallocate based off what happened last year, for example, right? So
Gotcha.
you don't also want to be chasing return either.
Yeah, and to put that also into perspective, so we talk about an 80% drop, just going back to that arithmetic, if you lose your 80% and you take your money out and you miss that next 2.5 years of growth, you would have missed 400% of growth, not only on the money that you lost money on, but you also would have missed that growth on the money you could have been investing during that time.
Yes.
And a 400% return over 2 years. I mean, I'm no math whiz, but that's 200% a year. You're tripling your money and every year for 2 years. So it's like, I don't want to miss out on that.
Correct.
But let's talk about the average recession, average bear market, average, all that good stuff, right? Average correction decline.
Yep.
So what is the average, or I took notes from online. So it might be wrong, but hey, Google doesn't steer me wrong. The average time that I found it takes from a recovery from a 5 to 10% decline is 30 days, 1 month. And that's over I don't remember the exact years, but I want to say it was like from like 1912 to 2020 or something like that. Average of 1 month. So we're at 12%. So averages say we could recover in 30 days. Now, with the current state of the world and all the different things going on, I'm not going to bet on that. The average time it takes to recover from a 10 to 20% decline is 4 months.
Yep.
So that would mean by the end of the year, we would have recovered if we're going off averages. And then the average time to recover from a 40% decline, if we end up getting there, is 6 years. Now, if you look at that 1 month, that 4 month, and that 6 year time frame, again, in the short term, it might really sting some people. But when you're looking at a 30 plus year retirement, 30, 40, 50 year retirement pool, again, it's mathematically insignificant to how you're going to be able to retire. So, can you speak on that a little bit, Joey?
Well, this also goes back to when you start looking at investing, right? You want to identify your time horizon, risk tolerance, and your investment goals. The main one there is time horizon. You're exactly right. So, perfect example. I know, James, you're really big into real estate investing and so forth, right? If you knew that I'm going to purchase, for example, my wife and I, we're going to purchase a rental property here in August, right? You're not going to be going uh, all in on domestic equities trying to chase return with literally your last penny that you're going to put towards the down payment, right? So it's one of those things where you really start to want to segment how you're saving. This kind of goes back to the budgeting podcast that we did, where you talked about needs, wants, and luxuries. But even more so, when we segmented that out, we also looked at the savings, as I always refer to it as essentially a absolute must. But when you look at the savings, it should be out of sight, out of mind. Most of the dollars that you're saving are with the idea that this is going to be at least 3+ years. But most of the dollars, especially money into your Roth IRA, you're not even going to touch that till you're 59 and a half. Technically, the IRS doesn't let you touch that till then without penalty tax anyway. So if you're 30 or 35 or heck, even 40, you've got 20 years before you could even touch your Roth IRA without the IRS penalizing you with the penalty tax, with 10% penalty tax. So same concept, right? That's all money that you should, out of sight, out of mind, contain dollar cost average, never look at. If you are in a scenario where, hey, we've been saving in our brokerage account, for example, that we're going to use it for a down payment. Yes, that's certainly where you will want to sell off the amount that you know you need and have that available. But this also kind of goes back into investing. You shouldn't invest in desperation or invest because you're trying to make a quick return. This kind of goes back to why I'm not a huge fan of crypto, because people are looking at crypto as a way to kind of get a 200% rate of return overnight. Right? It doesn't work that way. So we don't want to just kind of go all in and just hope it works out. No, segment your cash out, prioritize your financial planning goals, and prioritize how you're saving and where that money is going based off what we need to do with those dollars. So if you've done a proper budgeting, like James had been preaching, you've then also properly allocated your savings. This market recession should honestly be laughable. I remember during the COVID period, I had a client reach out to me, literally just being like, asking me, do you think I should take a loan against my house to put more money in the market? I'm like, well, that's a little extreme. We shouldn't go that. But, we've preached to that so much to clients that clients look at this as nothing but opportunity. And that's exactly why I wish that unfortunately we could kind of rub shoulders with the elite of the world or the wealthy of the world, because times like this is where the wealthy make billions, not hundreds, billions with the B of dollars, of being able to invest with discretionary income, right? So I always preach the idea too of, the concept of our tolerance for risk. People with a ton of discretionary income, their tolerance for risk is essentially insignificant. They could take on as much risk as humanly possible, because losing a small portion of income temporarily is nothing to the long-term return they're probably going to get on consistently investing in the market or investing in new business opportunities or where it may be, right? So we know we don't have that sort of power, but we can take that discretionary income, invest it for the long run, and be able to capitalize on market instances like this. Times like this are great for people. Even if you're 10 years out, we talked about, James, it was a great stat. I love that. 40% decline takes about 6 years of recovery. Well, if you're 10 years out, this could be one of those points where this is great for your retirement. If you're able to kind of capitalize on one more market decline before you retire, that is really going to help you be able to try to buy at a discount for another few years to hopefully really kind of spring forward your retirement plan on the back end. Yes, at that point, you'll want to start to become less aggressive, start to decrease how aggressive you're allocating your dollars into equities and so forth, right? Those are all kind of other planning items you want to work with yourself or your advisor. But even in the worst case scenario of a 6-year time window, that's same concept, right? If you're 50, that's more than enough time for your money to still recover and possibly capitalize on a market downturn. So I love those average stats because I think that at least helps put it into perspective for people who are really panicking in their 30s, right? Certainly nothing to worry about.
Yeah, and I think, with social media and news being at your fingertips, a lot of
Yep.
times they sell fear. That's how they get the
Yes.
clicks, how they get. So they want you to feel like we're going into a Great Depression. You need to buy weapons, bullets, and canned goods because but that's what they sell you.
Yes.
And when you get the real numbers, when you look at the averages, just like Joey just said, like this is somewhat laughable. If you were investing during COVID, I was much more scared in COVID with a 7% drop every day, like twice,
Yep.
to a 12% drop over the last 6 months. You know what I mean? So, and with that being said, something a couple of things I really want to reiterate. 6 years of growth. If we drop, let's just say we drop 40%, and it takes 6 years to grow. If you're not invested for those 6 years, you're going to miss 150% return over those 6 years. That is 25% per year. You're not going to get your money anywhere else growing at that rate on average, using average recovery times at that point. So it's really, really important for your money to be in and you to continually invest over that time. But there's also something else that I really want to bring up, that it's a quote, and I think it's probably my top three quotes that I know. It's uh, luck is when preparation meets opportunity.
Yep.
And a lot of people might look back and say, hey, man, you got lucky that you invested during that time, or you got lucky you bought a house during that time. And I hate when people use the word lucky, especially when it comes to investing, especially when it's someone who did their research and it took them 20 years to get lucky. You can't tell somebody who's been investing for 20 years, like, oh, you're so lucky. Like, no, 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 no. I played the law of averages. I played the average game and I won. That's not luck. That's trusting the system. And you talking about a client being ready to take out a loan against his home, that is preparation. I personally wouldn't do it, but high risk, high reward. And so, but him owning an asset, owning a home that he can now leverage to buy stocks at a discount, that is his preparation. And he's trying to use his preparation to seize the opportunity that we're in right now with a 12% decline.
Have you been listening to my client meetings, James? Because that's exactly I use the definition of luck literally all the time because that's exactly it. And it kind of relates to, we talked about, like, for example, I know student loans, something we mentioned, and we kind of joked about it possibly being a bad investment if you're going to incur $200,000 student loan debt to make 50 grand, right? I always view that as one of the scenarios where you're exactly it, right? We can become in a scenario where you go to school, you invest in yourself to incur or create the ability to make a six-figure salary. That's creating your own luck, right? And then the preparation comes into play where you're doing like this, you're listening to podcasts like this one, you're reading, you're doing your research, because then when you go and you start making that income, you create your luck by carving out your savings, building your savings plan first, and then building a lifestyle with the rest, and literally creating your own luck for the next 20 plus years, right? I could not have been a better said. That's something that I literally say all the time, because personally, I think that's literally the best quote you could ever use in all things of life, not just investing or, school or education, whatever it may be. You always know that there is no such thing as luck, in my opinion. It's all about creating it yourself. Yes, every once in a while you might, it's people think of luck as walking down the street and there's $100 bill on the road, on the ground. Yes. Is that lucky that you came across a random $100 bill? Sure. But most likely you probably saw it fall out of someone's pocket and you should probably pick it up and give it back to them, right? Create your own luck.
Yeah, man. And I will just break the ice. I'm pretty sure you said the quote on like one of the early episodes, and it stuck with me, man. But it does. It just sums up. It's like a lot of people think that, you can get lucky, right? People get lucky, they win the lottery, right? But let's be honest, that's not the way to get wealthy, because we know it doesn't work. There is luck in the world, but 99.9% of the time, it's not luck. Or as you would say, it's luck that you created.
Yep.
So,
and actually, I want to piggyback on your missing the top days because I actually have a booklet that I use. This is an old one, but I literally still use it. I got this in 2011 whenever I actually started in this career. So actually a little bit earlier, but so this is well over 10 years old, but it basically goes through just mistakes that investors can make. The number one is the risk of timing the market. And you're exactly right. What it essentially illustrates is if you go back and you look over the last 20 years from 1993 to 2012, which is 5,037 days. If you met and you invested during all 5,037 days in the S&P 500, you would have had a market return of 8.23%. We just talked about the recession during that time. So quickly, between 93 and 2012, we talked about the recessions that you'd have during that period. So this also includes, we talked about the dot-com boom, right? So this includes from 93, this includes actually I'll read them off from 93 in a negative 10%, negative 19, negative 12, negative 49, negative 14, negative 56, and negative 16 and negative 19% rate of returns during that period, different periods during that 20 years. So those are a lot of quote downturns, and you still got 8.23% rate of return. If you had missed the 10 best days, so 10 out of 5,037 days, your account would have been 4.5%. If you missed 40 of the best days, negative 1.95%. If you missed the 70 best days, negative 6.8%. So you want to talk about statistics. People are always about probabilities, right? If I have a high probability of success, I'm probably going to go that route. Well, 70 out of 5,000, that's a lot, right?
I'm trying to do the math in my head right now. I'm like, wait a minute.
So I have to do it now just because. So 70, it will divide by 5,037. So that's essentially 14%. So if you missed 14% of the days, you could have literally had a negative 7% rate of return.
No, that's not 14. 70 out of 5,000.
Yeah. So of the days, or well, sorry, 1.34. So no, you're exactly right. I added too many zeros. So 1.4. So less than 1%.
Yeah, I was gonna say there it is. That's the one.
So if you just stuck with it with a core investment strategy, literally you would have basically a 98% probability of getting over 8%. But also on the back end, if you just tried to mess around and pull your money out and get back in or time it up, you very easily could have been on the opposite and fallen in the 2% probability of people who really just kind of shot themselves in the foot. All while, if you're somebody who's also another kind of just is past performance, not indicative of future results. So if you're also someone who's going back and doing research and the only thing you're just going on the internet or you're going to morningstar.com and you're saying, all right, what was the top performing fund last year, right? Or the last 5 years? Well, if you go back during that same 20-year period, the top quartile, so the top 25% performing companies, so the highest rate of returns, the funds that were in the top quartile during the first 5 years, so 2003 to 2007, only 20% of them were in the top quartile again the next 5 years. Almost equal amount, so 16% was actually negative rate of return. Then from there, only 15%, 38%, then from there, only 15% were the top quartile. After 5 more years, 38% of them were actually in negative. So you're in a scenario where you start looking at that. If you're also just going back and saying, okay, well, what was hot last year or the last 5 years? That's also not a good strategy. Right? You don't want to go back and say what happened last year because that's going to repeat. No, that's not how it works either. It's not that consistent. So also trying to look based off of past results is also not necessarily the best strategy either. Also, just understand that we're living longer, right? So we have to understand that we need to make our money stretch. But I also like to use the last thing is just going back to just looking at the different type of asset classes that are quote top returners each year. So same concept. A lot of times people go back and say, okay, well, what was the asset class that had the largest rate of return? So we'll use 2010, for example. Small cap growth had a 29% rate of return, where international fixed income had 2.4%. So of course, if you went back and looked, oh, well, 2010 small cap growth is where I was at. and you threw all your money in there in 2011. Well, in 2011, small cap growth had a negative 2.91%, and real estate investment trust actually had a 10% rate of return, and were the highest asset class that year. So also trying to go based off what was hot last year is also not the best strategy. So going back to what we're constantly preaching is consistently investing, but having a consistent property asset allocator model to fit your risk tolerance, your time horizon, and of course your investment goals.
Man, I love that you brought that up, Joey, is because this is another thing that it's a question that has come up, and I'm kind of the same way as you. Like, I know that the top dogs aren't going to always be the top dogs. And so a lot of people say, well, look, James, this is what I can do, right? Boom, S&P 500, that's top 500. What I'm going to do is I'm going to go get the top 50 out of those 500. So I'm going to get the top 10% of the top 10%. And that's going to be my stocks. And I tell them, like, there's a reason why there's no S&P 50. There's a reason for it, right? There's a reason why there's S&P 500 is because the top 50 are not always going to be the top 50, and the top 50 are not always going to positively produce year over year over year. So I value diversification more than trying to pick the best dog in the race. I'd rather put
absolutely
money across all the dogs and turn a profit then.
Yes.
But I need to go back because I did the math. And you said if you miss the top 10 days out of 5,000 trading days over that 20 or that span of years, you cut your rate in half from 8%, 8 point something to 4%. That is a 0.002% chance that you hit all 10 days. So it's just, it puts it into perspective. It's like, the odds of you hitting those days, the odds of you waking up and knowing today is the day, Joey, today is the day, my man, this is it. The odds of you doing that 10 days out of the next 5,000, and let's put that into perspective, 5,000 days is 13 years. So it's not even a day a year. The odds of you doing that is, I'm going to call it impossible. You have more likelihood to hit the lottery than you do that. So trying to do that and risking cutting your return in half is not worth it. And then when we go to 40 and 70, where you're getting negative returns by missing 40 days out of 13 years, that's like what, less 3 days a year that you have to hit, or you have to try to hit, you have to try to time, is not worth it. And so I have the top returning days over the last 20 years. And the top returning day was 11.6%. So if you missed that one day, your money would have grown 11.6%. Then we have 10.8, 9.4, 9.3, 7.1, 7.0. And some of these were in 2020 after the March crash. But that just proves it's like, if you took your money out, if you saw the drop and got scared and you did not get your money back in before the next day, the odds are you were going to miss an 11% return, or you were going to miss a 9.4, 9.3% return. And you might be like, oh, I missed it, I'll get it next time. But that's the difference between returning a net positive over that 5-year, 10-year, 20-year span, and losing money over that time. So
I can't tell you how much it hurts me whenever I hear clients say, oh, I wish I had known this earlier, right? Or I'd done this earlier. Like, you could have, you just didn't. It's not a matter of knowing, you just chose not to. So it's also coming to prioritizing, right? Exactly like you said. It's not a matter of trying to time it. If you just went and started saving, you would have captured those days. But instead, sat on the sideline, wanted to time it. I have clients now or prospects now who we've done marketing events, reached out to do meetings, and we'll get a response with, oh, well, I don't want to do anything now. Wait till I figure out what the market's going to do. What do you mean? Like, is the market going to call you on your bat phone and say, hey, get ready? This is, like you mentioned, right? I don't know, August 4th is the day. Be ready. Call Joey. He'll invest your money. No, start preparing, going back to creating your own luck, getting that plan in place, and continuing to be prepared regardless of whether the market's going up or down. Right. So yeah, it's just silly.
Yeah, I 100% agree, man. I had a final note on this, is like, the only way to 100% guarantee not to miss the top trading days is to never step away from the table. Like, as soon as you leave the table, they're going to come.
It's always time in the market.
Yeah,
Yes.
as soon as you walk away from the table, your hand is gonna come, right? Like the point is you have
Yeah.
to stay at the table, man.
Yeah. That's what I'll tell my wife next time I'm trying to losing all my money at the blackjack table. I've got to stay here. We're gonna get that hand eventually.
Babe, time at the table beats timing the table. All right.
Yes, exactly.
All right, Joey. So let's go. Let's talk to the people because we do have some older listeners who are nearing or actually are retired and they're living off of this stuff. So let's talk to them for a second. And so I am what's the word? I am a wishful thinker. And I wishfully think and I hope that people build enough wealth over their lifetime that when they retire, regardless of how volatile their stocks are, they will be able to live. And by volatile, I mean like index funds, S&P 500, not Bitcoin and things that'll you can drop 90% a day, things like that. Not things like that, but like S&P 500, domestic stocks, and I shy away from bonds. So my goal going forward in life is to accumulate enough wealth to where I never have to rebalance to a uh let's just call it safer portfolio
Yep.
or at least a massive portion. So I would probably never want over 10% of my portfolio to be in like bonds or cash or things like that because I want it growing for the generations to come. But the key to doing that is to have enough wealth to where you're not pulling from that 90% in order to survive. You're pulling from the bonds, cash, and things like that to weather storms like this, to ride a roller coaster like this. With that being said, for those who have not, who decided, you know what, I'm going to just stay with my domestic stocks and I'm going to live off of those. And, although this is a storm, is now a time that they should be transitioning their portfolio to handle less volatility, or how should they be handling that?
I think, of course, it's, I have to give a little bit of a broad answer because everybody's situation is slightly different. But most likely, if you're kind of already in it at this point, you probably don't want to start selling at a loss. I mean, you certainly can start to reallocate. So, like for example, I've seen clients or people who have been all domestic equities and now are starting to basically just more diversify by getting their money in other asset classes, just because now basically everything is at a discount. So that makes sense to be able to say, hey, I'm basically now no longer buying at the top of the market. I'm going to go ahead and reallocate my portfolio to be more properly diversified. So I think if you're being more diversified, that certainly makes sense, especially for a long-term perspective. But people who are near retirement or actually in retirement, of course, time horizon comes into play. So if you're most likely 10 years plus still, then I think there's an opportunity to stay aggressive and hopefully try to take advantage of the market. If you're closer to retirement, then at this point, the one thing I always preach to clients is, and you already allude to a little bit with the idea that you don't just get to retirement and then at that point pull all your money out and just kind of sit on your pot of gold or put it all into bonds and just hang on. Because like something people look up all the time, or there's a general rule of thumb called the 4% rule. And basically the idea is that you should be able to basically just live off 4% of your total assets, because the assumption is you should be able to at least get 4% to basically just live off the return and not actually ever have to access the principal balance of your investments. Well, with inflation and things like that, I personally don't think that's a realistic scenario or something that we should expect. But also, that's not how we should go about managing our funds. We shouldn't just get to retirement, say you have $1 million, $700 million, and just call it good. That's probably not enough. What we actually have to do is now we just have to be more strategic with how you manage the money. So we always like to preach buckets of money. And the idea is, for example, let's say you have $1 million, $2 million, whatever number it is. But when we get to retirement, we want to identify what is our saving or our living expense, or what amount do we need to have to just live comfortably. So maybe between Social Security tax and Social Security and other things that you're receiving, let's just say that your total living expenses are 50 grand. So I need $50,000 a year off of retirement. So in that case, what I'll do is first we'll have 3 years. So 3 buckets. Each bucket represents a year. Years 1 through 3 of retirement, we're going to have basically 150,000 in cash. We need to make sure we secure at least the next 3 years of retirement. So no matter what, we've got that taken care of. Then from there, buckets 4 through 6, we're probably at least going to have at an 80 to 60% bonds, and then 20 to 40% equities. In years 5 through 7, we'll have it kind of the opposite. So 60% equities, 40% bonds. And in buckets 8, 10 plus, we actually want to probably still be at least 80% equities or higher, because there's no reason that we manage the money we're accessing this year or next year the same as we would the money we're going to access year 10, 15, 20 of retirement. So that kind of goes back to the idea I mentioned too of a common mistake investors do is also not account for the fact that we're probably going to live for a long time. We most likely will be retired for as many years as we're possibly working. So if I manage my wealth as if I'm basically going to be on a 5-year retirement goal, I'm in trouble, right? So we want to make sure that our money we're going to be touching in 10, 15, 20 years is still making money for us, because the average person who's retiring doesn't have enough. We might look at them like, man, I've done a good job. I have $1 million. $1 million really isn't that much money, especially if you're not growing it. If you just sit on it and you spread that out, $1 million, 50,000, even if you're saying $50,000, 50,000, 1, 2, 3, divide that by $1 million.
20 years.
Not even that.
But plus inflation, of course, lifestyle inflation. Yep.
Yeah. So you would be lucky to get 20 years out of that. If that, I would actually, it's even less than that. I would say you're probably close to, maybe 10 years, because also we're accounting for, typically when you're looking at retirement, you're kind of just accounting for living expenses. But one thing that happens is plans change. We might have, grandkids. We might want a, car, especially if you're driving. You're probably not going to have your car for that 20-year period. So you might want to get a new car. You might decide you want to, buy a camper, right, or whatever for traveling or so forth. So if you start also making large lump sum purchases, you're like, oh, well, I have $1 million, not that big a deal. What's a $50,000 camper? I'll just pay all cash for my car, right? All of a sudden, you're just taking years off of your retirement versus seeing that money grow. So you want to make sure that we're still seeing that money constantly growing over time, so that we're making the money we have accumulated work for us versus kind of sitting idle, letting inflation take over, letting unnecessary purchases or so forth take over. And then now you're in a scenario where you've literally dwindled down your retirement assets to hundreds of thousands, and you're still in great health and looking 10 years plus before you need it, all while we're not factoring any sort of medical or health expenses that possibly could come up. So there's a lot of things we have to account for, but the worst thing you can do is just transition all to bonds and just kind of sit tight. We need to make sure we're managing it appropriate based off each particular bucket per se. And what is your time horizon, how many years you have retirement. So there's a lot that goes into it. It's not as simple as just saving to retirement and then sitting on it. Doesn't work.
Yeah, man. And I think your bucket analogy, I wouldn't even classify that as just for retirement, because another skeptic that people have is like, oh, I have this emergency fund, let's just say 6 months worth of expenses, and the bank is giving me, 0.08% on my money, and I want it to grow. And it's like, no. Listen, your savings is not growth money. Your savings is insurance, right? You don't need that money to grow. You're going to have plenty of years, and your growth money is going to outpace your savings by a long shot. But it's still important to have that bucket, have that insurance money. That way you don't have to touch your growth money, because if you touch it this year, that's growth you're stealing from in the next 20 years. So I love that bucket analogy. And then also going back to retirement and living off your retirement and the 4% rule is like, the point is you want to, in the best case scenario, you want to live off the interest that it creates. You want to eat the eggs that your golden goose lays. The last thing you want to do is eat your golden goose, because now you get no more eggs, you get no more income, you get no more interest. You want to keep that bad boy healthy. You want to keep it fat and happy and laying eggs for you to live off of. So I love that. So Joey, last question when it comes to the stock market. And this is what all the listeners came for. When is the bottom? When do I need to put all my money in? When are we going to hit rock bottom? Is it this year, next year? Is it tomorrow? When is it?
If I knew that, I'd be charging everybody millions, and I'd be sitting on an island. But I personally, that kind of why I started the conversation with that with the recession and correction numbers, because the idea is markets history tells us we are just at the top of this quote bottom. If this really is going in the direction that we're seeing, where now obviously interest rates are rising, inflation's taking off, the Fed is in a scenario where they feel like they really need to kind of get a grasp and start to get things under control. Personally, they should have done this a year ago. The whole at this point, shoulda, woulda, coulda. I personally think we're at this point in it for the long haul. So I have been telling all my clients we should prepare for at least the next year or two of possible, even if it's not decrease, at least stagnant market returns. So we should know we're not going to be doing reviews in the next year or two where we're looking at 30 to 40% market rates of return like we were last year, right? So it's kind of preparing ourselves for that, all while still taking advantage of the situation we're in. But so something I always preach, like clients all the time will ask about, we'll be doing lump sums of money into accounts. So for people out there, I always say what we want to do is preaching the dollar cost averaging rather than, so for example, right now we're at negative 12% decrease in S&P 500 year to date. Do I think it'd be more? Certainly can. People say, well, is now a good time to go ahead and throw my money in? Stop trying to time it. Just get your money in, and most likely just dollar cost average it. Put it. So for example, if you're going to put, I know you want to do a lump sum of 10,000 or 50,000, divide that up over 6 months to a year and just dollar cost average it for the next 6 months to a year and just get it in and just consistently invest in the market. And who cares? Whatever the market does, the market's going to do what it's going to do, and just take advantage of that fluctuation versus trying to wait on the sidelines until we find that moment, right? It's never going to happen. So opportunity meets preparation, create your own luck, get the money in the market. If you have lump sum money now, I definitely recommend dollar cost average it. Don't just throw it all in. Or if you're consistently investing already, I would just recommend trying, if you can, just increase the monthly contributions you're making, if you possibly by however much you're able to, and let's just ride this thing out, because on the back end, you're going to look at this a year or two and be like, dang, I'm glad I listened to the James, because now I've captured all that. Yes, my previous funds that I had in the market that went up 30% or 40%, I almost lost that full value at this point based off the market decrease. But all the new dollars I've continued to put in were all at a discount, have all started to now come back. I've purchased a significant amount of more shares to now have a higher overall portfolio balance. So definitely the dollar cost averaging is something I'm going to preach as much as humanly possible. That's the best thing you can be doing at this point, because I don't think that we're at the bottom.
Yeah, I 100% agree, man. I'm just pulling it up real quick because I was looking at it yesterday. I just want to put it into perspective. Although we are down 12.2% in the S&P 500 year to date, if we look back the full year, the full 12 months, we are at a 0.2% increase. So we have not, a lot of people may think like, oh, my retirement's going down the toilet. No, your account is up from 1 year ago, still 1 full year. So again, it's a part of looking at the full picture and not looking at just the last 6 months of returns, but let's look at the next 12 months, the next 24 months, the next 2 years, 5 years, 10 years. We have no data that shows that it will not recover. 100% of market corrections or 100% of market recessions and bear markets have always recovered and hit all-time highs. So we have no data to say otherwise. Now, again, anything can happen, right? The country can go kaboom, but because we can't predict that's going to happen, and that's never happened to us, we have to go off what we know, and we have to just predict that history is going to continue to repeat itself.
Exactly.
So let's transition into mortgage rates climbing, because this is a big one for me. I'm in real estate. I'm trying to purchase a property right now, and it's tough, man. Mortgage rates are kicking my butt. So in January of 2020, rates were around the 3% mark, 2 to 3%. So if you could afford $2,000 a month on a home, you would qualify for a home worth $475,000. In May, at the time of recording this, mortgage rates are as high as in the high fives, low sixes. And I just got quoted on a 6% for an investment property. So you might be able to get like a mid to low 5 on a primary residence. But again, if we use that same $2,000 a month you can afford, your purchasing price is now down to $333,000. So you have lost in 6 months $150,000 in buying power as a home buyer. Now, I say all that to say, even though we are in the high fives, low sixes, we are still below the average we're still below the average because the average mortgage rates, at least since 2000, was around 9%. So if it gets up to there, you're going to be losing up to 50% of your purchasing power since January if we go from 3% to 9%. So these are really big deals. And I don't think this is what people are really considering. And it kind of makes me glad that I took advantage of I got 3 loans at 3%, 2.5%, things like that. Because now looking at it, it's crazy. So what do you think, Joey? Should people still be trying to purchase homes and investment properties, or do you think that they should be moving towards, I don't know, more into stocks and things like that to get the returns? Or what are you thinking about this whole mortgage interest spikes?
You're exactly right. 5 or 6% interest doesn't bother me at all. I mean, I look at that as technically, remember, a lot of times you get to write off the interest on those rates. So your true cost of that rate's less, right? So if you're at a 6%, your cost of that loan might really only be like 4% when you factor in the tax deduction you're getting on the house. But also during times like this, most people also, the average person's flocking towards renting instead of buying. I look at it as, if you're in a strategic situation where you're able to, of course, this goes back to the luck conversation, right? If you're someone who's put yourself in a scenario where you have the assets, you have the capital and the ability to get into to real estate or investment property, it's a great option for you because now you're in an advantageous position, right? Typically during scenarios like this, the average person's going to look at that who's maybe looking to buy a house and be like, oh, I'm going to wait. I don't want to pay 5 or 6 or 7%. I'd rather rent. Well, there you are. Your rental pool is probably going to go up over this period because people are going to stop purchasing homes because it just costs too much to lend money. So for someone like yourself who's in investment property, it's a great option. But even then, it might be the size of home that they're purchasing just because the rates are so good. I think some people are certainly being overextended in terms of what they probably could truly afford. And that kind of goes all the way back to the 2008, the housing market crash. Am I predicting that? No. Do I think that'll happen? I have no idea, but that is something that's kind of led to that scenario. So it's wild out there right now in terms of how people and how really desperate people have been to just get into a home. So a lot of people are now locked themselves into a decent rate. So you might look at this now as just your purchasing power might not be as high. So you're probably going to sit on the sidelines. For someone investing, good option. So for you, I think it certainly makes sense, but I still would not be scared. If I got to like 9 or 10, maybe I'd probably second guess it. This kind of goes back to our debt repayment option, right? My wife was talking about how she said she's a real estate agent, and she had somebody mention how they remember when rates were around 9 to 10%. Well, Becky, that's also when her houses were like $100,000, right? So when you had $100,000 house at 9%, wasn't a big deal. But if you're looking at $250,000 house at 9%, that's a significant amount of interest, and probably something where you almost start to get to a scenario where you probably are actually going to look to try to pay that off sooner, just because that's a heck of a debt to carry. So that goes back to that good debt versus bad debt example we talked about too.
Yeah, and I like to, because a lot of people kind of don't take into consideration that even though rates are 4, 5, 6% right now, and they're not as low as they used to be, let's say there's 3 options, right? Let's say you buy now and you have let's just call it 6% to be cute. If rates go up to 9%, now you're looking good. You're like, yeah, I locked in 6%. They could continue to go up. They could come back down to 6%, but regardless, I am locked in right now for that 6% for the next 30 years. Now, what if rates go down, James? Well, they got this awesome thing called a refinance. So if rates go back to 3%, you can always refinance and get that new lower rate. So you have purchasing now, and by now, if you're listening to this and rates are 9%, it's the same as if rates are 6% or 3% or 12%. Purchasing now, you protect yourself from all of the volatility of rates going higher, and you have all of the upside that if rates go lower, you have the option to refinance or pull money out if you want to for other investments. So it's a lot of times people say, should I be buying now? I will say it is very difficult for me to find deals right now that the numbers work. I have to submit
Yep.
offers that are lower than asking price in order for the numbers to work. And that's just the price I
Yep.
pay as an investor. But I'm still not going to stop buying because again, if rates drop, I can always get the new rate after like 6 months. And if they go up, I look smart. So I truly don't see a downside in buying now as long as the numbers work. That's why when people bring up interest rate, I'm just kind of just like, listen, forget interest rates. They're going to do what they're going to do, and it's not going to stop people from buying homes. So, yeah, I think it's kind of the boogeyman. You know what I mean? It's like, and as you said, a lot of times, for example, a $475,000 house isn't the same as a $333,000 house in the same area. And so losing that purchasing power, you're also losing, you might have to buy a smaller house in that price range, or you might have to do repairs. And people just they don't want to deal with that headache. So it's when there's blood in the streets, as they say, that's where the investors make millions and billions of dollars taking advantage and seeing all of the upside and comparing it to the downsides, but a lot of people just aren't
Right.
looking at the upside when it comes to things like mortgages.
You're exactly right. I mean, my wife and I have a similar scenario where we actually looked at a few areas where they're really hot up and coming areas. And you looked at and you're like, yeah, the numbers aren't going to work based on what they're selling for now. So that's it. Kind of goes both ways. From an investor, you're like, I would love to get in that property, but I understand what the numbers are, and I'm not going to go get a home that I know that in terms of what it's going to rent for is maybe $2,500, but it's going to cost me $3,600 to get into it. No. um, so kind of looking at it that way, even from a buyer. Yes, you're not going to be renting out the house, but you probably don't want to also be in a scenario where you're going to be buying basically over what it's even areas like that are renting for, right? So now you're in a spot where you're probably overpaying. So what is it worth to you? I think that's another thing you have to ask. If this is your forever home, this is something that you and your family have been looking at for the last, saving up for the last 5 years to do. I think 6 compared to 3 shouldn't deter you at all. You certainly should do it.
Yeah, I think when it comes to, especially if you're buying a primary home, there's a laundry list of things you should be looking at before you get down to the interest rate. You need to be
Mhm.
looking at what is it going to do to your living expenses? Are you going to spend more renting? Or are you going to spend more owning? What is it going to do to, is the home going to appreciate? Is it in an area where people are coming to and homes
Yep.
will appreciate? You know, it's just it,
School district, all those things.
yeah. So it's like, will it accommodate your family? Will you be there for longer than 5 years? So there's a laundry list of things you need to look at before you get down to the interest rate.
Right.
Because to generalize, the house isn't going to get bigger. The house isn't going to move. These are permanent things. With that interest rate, it can always move and it can always be changed, and you can always take advantage if it
Yep.
gets lower. So that's why it's very, very, very low. And it goes the same with investment properties. The property isn't going to move. Rents might go up, but the property necessarily isn't going to get bigger. It's unless you, of course, plan for that. But the point is, interest rates is far, far down that list if you're looking to purchase and if you're in the right financial space to purchase.
Yeah.
So let's go to the big bad wolf in the room, Joey. Student loans. There's a whole lot of topics, news articles, debates on what student loans are going to do. So there's a rumor on the street. Joey Boy, big Joey, not this Joey, but Joey Boy is planning on doing some form of forgiveness.
Yeah.
I guess the biggest one I've seen is $10,000 per borrower with income limitations, like
Correct.
$125,000 for if you make $125,000 or more. For individual filers, you won't qualify, and for couples, it's like 250 to 300 for. So What are you advising clients to do? Because a lot of people are taking advantage of the forbearance. They're saving the money on, they're paying minimums, which is zero, and there's no interest. So they're
Yep.
using that money elsewhere. But what are you advising clients to do at this time?
So my best advice is always, if you're, of course, I am advising not to make payments just because I don't, if you're possibly someone who's in a situation where you could get loan forgiveness, there's no reason to pay for loans that are going to get forgiven. So it definitely makes sense to save it elsewhere. The problem people are running into is I'm advising them to invest it, not spend it. Right? That's the big issue. We talked about debt repayment. If your solution is simply to go take the money and just increase your lifestyle, that's a bad idea, right? Because once that loan starts becoming uh owed back all of a sudden, and now you don't qualify for loan forgiveness, well, guess what? Those loans still need to be paid. So now you're going to have to adjust. So that kind of goes into the whole buying a house and so forth, right? Going back to affordability. If you went and overpay for a house because you basically accounted for the fact that now you're getting an extra $1,000 a month because you don't have to pay your student loans, well, now that $1,000 a month starts, we're in trouble. So if you're going to pay the minimum or pay zero, then definitely invest the difference. Don't just start spending it. But I am of the mindset that I personally am always going to advise, let's not do anything that has to rely on somebody else creating our own luck, right? There's certainly no reason to assume that the government's going to do us a favor and forgive our loans. If they do, awesome. We no longer have to pay the loans. We've got money. We have that set in stone. But most likely, I personally think that one of those scenarios is going to come to fruition where there'll probably be some sort of income limit restriction on it, on who gets loans forgiven versus not. And it probably won't even be that big of an amount. It's still probably going to fall back towards the just current plan that's been enforced for the last 10 years, where if you're at a 501c3 and you've made qualifying loan payments, then you might qualify for payments. I don't see it suddenly all of a sudden coming back and saying, great, everybody, doesn't matter how much you make. If you have loans, they're gone. That would be awesome, but I wouldn't count on that. So I'm always advising people, pay a course zero until now. It looks like we've got to start paying here at the end of August. As of now, of course, certainly they can come out and extend it because they have done that a handful of times. But for now, invest the difference, continue to save, be prepared so that whenever that does kick back in, all you do is just shift the money you've been saving anyways, it's just going to investing. We just shift that back to our student loans. We don't have to make any significant changes or adjustments to our lifestyle. We just continue to go about our business as always. So definitely that's the strategy I've come up with and have advised people to do. But I would not count on getting my loans forgiven. I think that's a bad way to go or to do business, just because it's something you can't control, right? The thing you can't control is the loans you obviously took out, the income you're making, the way you're saving. Those are all things we can't control. We can't control how they're going to change this program. So I definitely would not count on it.
Yeah, I love that you brought that up. Control what you can control. As soon as you put your fate in someone else's hands and think that they have your best interest in mind, you've lost. And
Yes.
I will say I was reading an article a couple of weeks ago because the when you're working for a nonprofit, they have this 10-year student loan
Yep.
forgiveness, but there were some problems with it. For
Yes.
example, if you missed the student loan payment throughout that 10 years, you were no longer eligible for forgiveness. And it ended up being like only 3% of the applications were getting accepted. But I did see an article to where they were fixing a lot of those hidden small print things where they're actually reaccepting applications for people who have made, I think it's like 360 qualifying payments. So even if you miss the payment over that 10 years, as long as you still hit that 360, now you were able to apply for loan forgiveness and get it accepted. And so they were removing all of those limiting hurdles that people were facing in order to get the loan forgiveness after that 10 years. So that's positive news. I haven't read much into it after that, but I did see that they were telling people you need to resubmit your application after you've met that 360 qualifying payments, and that it was having a much, much, much higher success rate for the loan forgiveness for the 10 years as a nonprofit. So I wanted to bring that up. And I'm going to try and find that article and link it down in the show notes, guys. We're going to have a bunch of different resources in the show notes to just go over what we were talking about. And then, Joey, I have one question that it's been burning in my mind. And I'm like, I want to text them and ask them this, but I also want to do it on the podcast, right? So there's for student loan repayment, there is an income driven repayment plan
Yes.
where I think it's like 10% of your gross income is the max they would make your payment. Is that right?
Yes. Yes.
So if someone is in the case, let's just throw out I'm just gonna throw out random numbers. Nobody's in this case, but let's just say someone has $400,000 in student loans and they're making $40,000 a year. So they're capped at paying 10%, which is $4,000 a year in payments. But the interest on their loans outpaces that. Does the loan go from being an amortized debt to a compounding debt in those circumstances?
It's so no, just because it's still calculated as a amortized debt. The problem is you're just not paying enough to cover the amortization, so it feels like a compounding debt. So in terms of what it looks like, you're exactly right. It's gonna feel like a compounding debt because the fact is you're not even paying enough to cover it. But you're exactly right. So when it comes to loan forgiveness, it's 120 qualifying payments. You have to make it a qualifying payment, has to be at a 501c3, so essentially a non-profit, and a qualifying payments an IBR, so income-based repayment, a repay payment, or IBR repay or pays you earn payment. All three of those, or a standard 10-year payment. Only those count as qualifying payments. A 20 or a 30-year standard payment does not count. So that's the problem we run into, is that if you're someone whose income is going to keep going up over time, exactly what you just mentioned, typically you're capped at 10% of your income. Well, if your income constantly is going up over time, you're only going to increase the amount of money you're paying. So you could be in a scenario where you end up paying more going down that route towards your loans than if you just refinance them. So refinance has actually become a really good option, or something I think is something people should consider, because there are a lot of private lenders out there who have great refinance options of around 3 to 4%. So to me, from a financial plan perspective, if you could refinance your loans and lock it in at 3%, that's a big difference if you had 6.8% student loans, right? So just a decrease from 6% down to 3% is going to drastically reduce the payment. All while you can lock it into a 15 or 20-year repayment, pay the minimum, and invest the difference. We know that number is never going to change compared to if you're someone who's doing a 10-year, or they also have like a 20-year graduated plan where in the next 20 years, if you're not at a 501c3, you could do a 20-year graduate plan where it, of course, is based off your income. And if your income keeps going up, you're just paying more and more, right? So you're in a scenario where as your income goes up, it kind of negatively affects you because so does your student loan payment. All while after that 20-year period, it's still, they're talking about this is part of this program that they're trying to fix, because the whole loan forgiveness program came out basically about 11 years ago. So this last year or two is where people were finally getting loans, quote, forgiven, which goes back to the article you mentioned where there's a lot of people whose loans, there was missed payments and people aren't getting them forgiven. So make sure you're paying attention to how many qualifying payments you have. All while during COVID, this period, all the payments that you weren't making still should count. So this is actually a cool opportunity for everybody who is during this period, because you basically got almost 2 years or so of basically zero payments that all count towards your qualifying payments. But if you're in the 20-year repayment, there are conversations about after we get to that 20 years, yes, your loans will be forgiven, but you might owe taxes on what's forgiven. Well, we don't know yet because we haven't gotten to that 20 years to find out. Right. So this will be a whole new conversation basically 9 to 10 years from now, where people who are in the graduated 20-year option who weren't at a 501c3 or nonprofit, did they get their loans forgiven and did they have to owe taxes on that amount? Right. So there's a lot of still unknowns to this, but I definitely, if you're at a 501c3, make sure you're taking advantage of the qualifying payments. But going to the example you used, if you're making 40,000 and you have $400,000 student loan debt, you being in a 501c3 is probably your only option, and sticking out the 10-year options and just getting them forgiven after that, because you're probably never going to be able to realistically afford the payment. So unfortunately, that might be your only option. So that kind of goes back to not necessarily as being the best investment we talked about.
Yeah. Oh, so
But
definitely not the best investment.
James, I don't think I did this last time, but I'll send you an article. Our North Star has done a good job of kind of keeping track of all this student loans. It's something we deal with a lot. We have a couple articles we put out, so I'll send you some client approved ones if you'd like to have them just available for people to look at, just kind of giving some of the nuances of mostly specifically the loan forgiveness program and how that works. And especially people mostly in the medical field who are dealing with student loan or forbearance issues and what to do. So at least give some general advice and some information and people to contact. So we have in-house loan advisors that we use a lot too. So certainly if you are someone who's in a scenario where you're just not exactly sure what to do, we can at least point you in the right direction on someone to help advise you and walk you through that.
Yeah, of course, guys. And I'm going to have all Joey's contact information and all of these articles that we're talking about in the show notes. So, Joey, what do you think? I don't want to get too political, right? But I do want to ask because I think I've come up with like the bulletproof plan for all of this, right? But I want to get your opinion. What do you think is the appropriate course of action at this point to solve or at least to reduce the student loan crisis as a whole?
You know, I it's one of those things where unfortunately I think the government's created a little bit of a monster in terms of the amount of lending that was being had at pretty significant rate, right? Um, so unfortunately, there's not a perfect solution, but I think a happy medium, because also no one's ever going to be happy, right? If you're somebody who busted your butt and you paid, like, let's say you came out of college, you had $150,000 student loan and you worked 3 jobs. Like I have a friend I know of who literally worked 3 jobs and paid off all their loans in like 4 years. You're probably pissed, right? You're super mad right now because you're like, wow, I had all that work to pay off my loans and now people are going to get theirs forgiven. Right. So no one's going to be happy whether you're the person who has a ton of debt or zero debt and you paid it off. But I do think that income driven perspective is literally the best solution, because at least gives people who went into student loans with the idea, who took on student loans with the idea that they were going to be able to make a livable wage. And that livable wage was going to give them the ability to not only make a livable wage, provide for their family, save for retirement, but also pay those loans back. Right. So unfortunately, I think the bigger issue is that wages should have also adjusted with inflation. People should be making more. Where inflation has been projecting, even the last year was at 8%. I promise you, wages have not gone up by that much, right? So that's really the bigger issue, is that the income people are being paid for the loans they're taking out isn't matching up, right? So I think probably what will eventually happen is that they probably just gonna have to reduce the either cost of college or just the amount of loans people can take out, because there's no reason that somebody should have to take out $300,000 student loans to become a teacher, right? Or even be able to do that, because they're only setting themselves up for failure by incurring that sort of debt amount to go make 40 to 50,000, and then be in a scenario where they have to rely on a program that's income driven to even live, right? So I think the income driven program is one of the best options, just because it kind of has a happy medium, and they are making changes. So they, like you mentioned, they've been making a lot of changes in terms of what counts as a qualifying payment. They've also been giving loan forgiveness on some online schools and colleges that people went and took like a trade course or something like that, that they paid 30 to 40 grand for, and it resulted in zero really job opportunities or increase in compensation. So things like that, they've already kind of made some adjustments to help forgive those sort of loans, because it didn't help create someone's earning potential or increase earning potential. So they're making some changes towards that. But unfortunately, I think there's still a long way to go. I don't know if that necessarily answered your question, but I do like the income driven stuff because I think it at least gives some relief. But dang, even look at that amount. So $150,000 as an individual filer, as being like, under that, that's still not, there's people who are making 120 to 150,000 who have $340,000 of debt. That's still a huge burden to carry even at that income level.
Yeah, so I think that you bring up you bring up some good points, right? Limiting the amount of projected income, because like you said, if you make 120 and you owe 400, that's still 3 to 4 times your annual income, and that is a big burden to carry. So putting limits on loans for projected income, I think, is a great first step. Otherwise, I mean, I I neglect to say like stop making the loans at all. I don't think that's the solution, but I think limiting it to
Yeah.
maybe maximum twice your projected annual income is maybe a start. Income redriven, I think, is an absolute. I think it's great. That 10% mark to where you're not absolutely drowning, but you
Yep.
still have the responsibility to take care of. I think that's really
Yes.
good, and I would keep that. The forbearance, right? Because we're all currently in forbearance. I personally think the forbearance needs to end because there's two people, right? There's people who can afford to make their payments and they're just either spending the excess or investing it. I think that they should, continue making their payments and pay off the debt.
Yes.
But I also think that there are people who cannot afford the payments right now, people who are still suffering from the aftermath of COVID, losing a career and things like that, or losing a business. And I think that forbearance should be an option to continue for them. But I also think that it just shouldn't be blanket for everyone.
Exactly.
So I think that would get us out of our current, situation where nobody's paying, but it also gives relief to those who truly cannot afford to pay. And then
Yeah.
the last thing, which I think is, I don't know, man. I might be kind of harsh, but I think making student loans bankruptable is probably the best course of action because
Mhm.
it will decentivize students from over leveraging themselves, and it will punish them if they do so by having a bankruptcy on their record, hindering buying a home for 2 to 3 years, and things like that. But it's also going to punish the predatory lenders who are lending
Correct.
students money with they know the government's going to guarantee it, so they're writing blank checks. And I think that they should be punished in some way too by
Yeah.
not recouping their money through a bankruptcy. So I think both, I really think that's a happy median to where if a person feels like, you know what, I will never be able to pay off these loans, so I might as well bankrupt them now and deal with the consequences of that. And everyone's not let off scot-free by just forgiving everybody and, throwing our hands up and just
Right.
giving out free money. So
Yeah.
that's my
You're
2 cents
right.
on it.
Yeah. I
And
agree with you.
then,
I'll say I definitely agree with you because you're exactly right. It's more it's a much larger problem than as simple as just people are taking out a lot of loans and aren't making the money they should be making. I mean, lenders are giving out hundreds of thousands of dollars to people and letting them basically live off of those loans for how many years while they quote go to school. And a lot of times, for example, they're going to like a trade school, right, or something like that, or going to like an online course, and then it's not resulting in a opportunity that creates a livable wage. So it's a entire problem, not only from the academic side, the lending side, and of course the individual side. So everybody plays a part in it. So I'm with you. If everybody can be equally culpable for the issue and have to at least have some sort of quote skin in the game, I think that certainly could at least be kind of going in the right direction, anyways.
yeah, I think no one wants to take accountability. Students
Yes.
don't want to take accountability because they took out the loans and they just got scammed and all this stuff. Lenders don't want to take the responsibility because, oh, students took out the loan, so they're responsible. And of course, the government doesn't want to take responsibility because they're kind of
Why
just a
would
guarantor. You know what I
they?
mean? It's kind of like co-signing on a car. It's like, this is their
Yeah.
car. I'm
Yeah.
just a guarantor. So
Exactly.
Joey, the last thing I want to cover, which I'm completely ignorant on, so all the information is basically going to come from you, is something called I bonds that I
Yeah.
literally just learned about the last couple months because of the interest that they're paying right now. And so, what is it? Do you think that these I bonds, since they're returning higher than normal, do you think that this is an avenue that some people should be taking advantage of? If so, who should be taking advantage of them? And what's your just opinion on them?
So I've had a handful of clients reach out to me, and basically the exact sentence they send me is, "Should I do this?" Right, or "I-bond's a good idea." Pretty much the opening line to my email and everybody's response is, "I-bonds is going to play a very limited role in my financial planning practice and my clients' practice because this is completely off topic. It kind of goes into the whole we weren't here to have a political conversation or anti-government, but I look at this as the government's way to kind of just distract people from the reality and thinking that, oh, this is a great safe option to do, right? No. Well, when you look at I about one, it's only a $10,000 cap, so you can't get more into it than $10,000. But also, it's definitely a very short-term solution because they technically are five-year terms. Within the first year, you can access within the first year. If you do, you lose like 3 months of the interest. You're not even going to get your full return if you try to access it early. So it's not liquid. So you have to understand that it's not as liquid as we think. All while it's currently at, I was just looking it up. Let me pull up the numbers again. So currently the interest as of May 1st, 2022 was 7.12%. The CPI year to date from April to April is 8.3%. So the government's not even giving you inflation, but they're dangling this carrot out in front of people like this is some sort of great option. You're not even keeping pace with the inflation with this supposed I bond, but people say, "Oh well, Joey, it's guaranteed." Okay, sure. Maybe again, as I mentioned, it's not a long-term thing. They technically have a 30-year maturity, can be redeemed after 12 years. If investors redeem that between 12 months and 5 years, you forfeit 3 months of the interest. So really, it's a 5-year option. It's not even a 1-year option. They tell you could access it, but if you access within a year, you actually lose nothing. After 12 months to 5 years, you'll forfeit 3 months of the interest. So it's not a long-term savvy financial planning move, and it's only $10,000. So when you look at that amount, you're going to have to buy a lot of these. I have not experienced or really had any conversation with clients in terms of their experience of purchasing this. I've heard good and bad in terms of it being easy or not so easy to do. But this goes back to my initial point. It's just a distraction away from what we should be doing, and that's sticking to the core investment strategy. We've obviously preached literally every podcast, and you're doing plenty of other individuals, that the best way to fight inflation or just interest rates raising, markets going up and down, is consistently investing, not only consistently, but staying in the market for the long term, right? And consistently investing, take advantage of dollar cost averaging. So I will certainly never be a person who recommends I bonds. I definitely will not be buying any, nor am I recommending my clients to do it in most scenarios. I think it might be something where, going back to the example we talked about, let's just say hypothetically that you did have investment property and you just conveniently only needed $10,000 for it, and you needed it in 2 years from now. Maybe that would be a good scenario where you go put $10,000 into I bond, you sit on it for a year, and then you just swallow the 3%, the 3 months of interest off of it, and you only get, 4%. In that case, you at least had a little bit of money, but you're going to lose money on this by doing it, because if inflation is already higher than the rate they're giving you, so you've already lost money, all while it's taking away from opportunity you could put into other areas and be buying at a discount. So you should look at this as basically, I'm just going to ensure a way that I can't lose more money. You're still going to lose money. You're just not going to lose more.
Yeah, I mean,
look at it.
That's a good way to put it, though. It's like you're going to lose money regardless. Inflation is hitting every single year, whether it's 2%, 8%, whatever. You're always going to lose money, but this is a way to lose less. I like that. Joey, I think we covered a lot. So I think today, look at that. I think we covered a lot, absolutely, man. And it's so much to take in, and things are changing day to day. Like I'm pretty sure, I think tomorrow on Memorial Day, they're releasing more information about student loans. So all our information just could be outdated. They could forgive them, but we never know. But I think it's going to be helpful for people to be able to listen to this in real time and deal with, because we normally record episodes a little bit in the future, 30 to 60 days. And so a lot can change. So this coming out on the 31st of May is going to literally be current information. At least we recorded on the 30th, so things could change tomorrow, but it's the most current that we can get. So I really appreciate you spending the time coming on today and having the conversation, just going over all this, and hopefully people can make much more educated decisions as the landscape of investing continues on its little roller coaster path with interest rates and the market and things like that.
Absolutely. Hopefully, when people wake up tomorrow, the I bonds didn't go up to 10%, and make us all look silly.
Yeah, and then you're making 2% compared to inflation. Yeah, so exactly. Hey, man, maybe. But all right, Joey, man, we're gonna get up out of here. I appreciate you joining, and I hope you have a blessed rest of your day, man.
Absolutely. Happy Memorial Day to you, James. Especially thank you for your service and all those who have served, and of course those that, as my uncle said, those who of course sacrificed the greatest sacrifice. So thank you everybody, and definitely enjoy your day.
And guys, that is our 2 cents on what is going on in the market today. right? We talked about I bonds, we talked about inflation, mortgage interest rates, student loans, whether they're going to be forgiven or not, and of course the stock market, the SP 500, seeing what do we think it's going to do and what you should be doing. You know, we brought a whole lot of different stats, articles, and statistics to show market average downturns, you know, the worst downturns in history, the most recent one due to COVID, and how people were supposed to be reacting, how fast it rebounded, just to give you guys more confidence that, listen, this isn't the first time that we've gone through this, and this isn't the worst time, and it's always come back. So if you're going to take anything away, is buy now, don't wait. And that goes for everything. That goes for real estate. Buy now. If interest rates go down, you can always refinance and get a new rate. If interest rates go up, now you look like the smart guy because you're at 6% and everybody else is getting 9, 12%, if that's where we get to, right? So, and then the market, buy now. It has a 100% recovery rate up to this point. So unless we go into nuclear war or the country absolutely collapses, you're gonna be fine. I have hopes and faith that you're gonna be fine in the long run, as long as you have a 20, 30, 40-year investment horizon before you're ready to use those funds for retirement. But I really hope that you guys enjoy. Like I said, I really wanted to bring you guys something current because I want to ease the pain of those who might be stressed or, you know, whatever the case is. So I really hope you guys enjoy. Of course, all of the articles and things we reference are going to be down in the show notes below, that you guys can actually look at it yourself to formulate your own opinion. You don't have to take our word for it. You know, we don't know everything. That's why I asked Joey, when is the market going to recover? And he didn't have a day. I didn't have a day, and no one will. And if they tell you that, they're lying. So I really hope you guys enjoy. Of course, if you guys are listening on any Spotify, Apple Music, Google Podcasts, make sure you guys leave a review. It helps get the channel out there a lot. I'll have all Joey's contact information in the show notes, so you guys can get in contact with him if you want to. And yeah, we're going to get up out of here. Make sure you guys subscribe to our YouTube channel down in the show notes. And if you want to become a guest, make sure you go down to our website and apply to be a guest. I'd love to have you on and share your story and have your conversation heard by the whole audience. But I really hope you guys enjoyed the episode. I'm going to get up out of here. I'm your host, James Bowman. And always remember, you're only as secure as your ability to perform. So spend your life accumulating assets that can perform for you. Later, guys.